Hey guys, Michelle Kinney here. Thanks for checking in. Thanks for checking out my video. Today I'm going to make a super quick video on choosing the stock that you're going to trade options on. So someone this morning in my Discord channel asked, as one becomes an option seller, does it pay to specialize in a certain stock or a small group of stocks? So that's a really good question, and I'm going to answer that here right now. So first of all, I want to let you know that when it comes to trading, there's really not any one right answer or wrong answer. It's like what's right for you. But generally speaking, the first thing that you want to think about when you're deciding what stock to trade, it's always very helpful if you start with something that you're familiar with. So don't go to a cocktail party and you heard somebody, at the wine counter talking about he trades XYZ stock, and then you're going to take a tip like that. No, don't do that. It's often helpful if you start with a company that you're familiar with and that you know of. So let's say Apple, for example. Like I use an iPhone, I use a MacBook. I know Apple is a super big company, very strong. Could they go out of business? I guess technically anybody could go out of business. It was only just a few years ago that Lehman Brothers, the banking institution who had been around for like 100 years, I think, at the time, went bankrupt. I remember when that happened. So could it happen? Yes. Is it likely? No. So start with a stock that you're familiar with, that you know. Second thing that I want to recommend, and that said, I do want to say I'm not recommending any particular stock. I'm not a financial advisor. I'm not giving you investment advice. I'm just helping you, educate you on how you can trade to, give yourself income and live a lifestyle that you're looking to live, perhaps. So the second thing that you want to be aware of, that I often tell people that I'm teaching in some classes that I host from time to time, is you want to calculate what we call the intrinsic value of a stock. So a stock really, will fluctuate. So it will go up and down, right, as the market moves. But there are different ways that you can calculate, how much should a stock be trading at. And the advantage and the value of doing that is kind of like, it gives you sort of like a buffer. Like, let's say if you calculate the intrinsic value of a stock to be $100, let's say. And you can calculate that mathematically, given like earnings per share, expected growth, that kind of thing. I have some formulas on some other classes that I have, and put some comments in the comment section here if you want to know more. But basically, you can calculate an approximate intrinsic value of a stock. So let's say you calculate the intrinsic value of a stock to be $100, let's say per share, and the stock right now is trading at $150 per share. Well, in that case, you might perhaps look at a different stock because it might be overvalued, right? So that's not to say that it's not a good stock, but it is to say that perhaps it could be, coming to a point where it's going to have a downturn. Conversely, if you calculate the intrinsic value of a stock to be $100 per share and the stock is trading at $8 per share, maybe that's a stock that you might end up looking at a little bit more heavily, right? So that's something to keep in mind. Most importantly, I always, on a trade, before I put any trade in whatsoever, I always calculate annualized rate of return. So I put in, and there's a mathematical equation for that as well. I'm developing some apps that help automate some of these things, but I have a lot of these calculations in the classes that I've taught online, and put a comment here if you want to know more, and I'm happy to send you some information. But basically, you can calculate mathematically, and you can just do it with a calculator. You don't necessarily need an app to do it, but you calculate, how much is the premium that you're earning from the contract that you're looking at, whether it be a put or a short put or a covered call. How long are you holding it for, right? What's the expiration? So let's say if you put the trade in today and it expires tomorrow, you're holding it for, 1 day, 2 days, or does it expire next week? How many days are you holding it for? And then how much are you putting up to make the trade? So you could, let's say, not have a margin account, and let's say you're selling a $100 put, let's say. If the strike price is $100, that would mean that you'd have to pay $10,000 if you were to get assigned, right? 100 times 100 is 10,000. Most people trade with what we call margin, right? Kind of like when somebody buys a house. Usually you don't pay the whole thing for a house. You put up a small amount and then you take out a mortgage. Margin is very similar. You put up a small amount and then the broker dealer kind of floats you the rest. So you can calculate how much do you have to put up to make the trade. So how much am I putting up to make the trade? How much am I taking in? How long am I holding it for? What's my annualized rate of return? So that is a very, very important thing, because you really don't want to, a lot of this stuff is mathematics. You don't want to make a trade on a stock, let's say, that doesn't have a really good rate of return versus how much you have to put up to make that trade. You don't want to make a lot of trades like that. You want to trade in such a way that you can still be wrong, like a lot of times, let's say, and make money. Like this isn't like the game, let's say, where you have a crystal ball and you know what's going to happen tomorrow. I don't know. Maybe you do, but I don't. Maybe it goes up, maybe it goes down, maybe it stays sideways. I have no idea, right? So I want to trade with mathematically, where I can be wrong sometimes and maybe it goes down, but I don't want the company to obviously go out of business, because then you could lose all your money. But calculating your rate of return is very, very important. Somebody recently had said something about like SPY, SPY. SPY is an ETF, an exchange traded fund that tracks the S&P 500, right? And I have traded that from time to time. It's been a long time since I've traded that. And the advantage, I think nowadays, I think it has like daily expirations. I think a while back when I was trading it had like expirations like Monday, Wednesday, Friday, if I can recall. Instead of, most stocks are like every Friday. So the advantage of trading SPY, as an example, was that it had more frequent expirations. However, the volatility on SPY is very, very low. What's volatility? Volatility is kind of like the swing. How much does it swing, right? So it doesn't swing that much. So when volatility is low, implied volatility, the premium that you're getting paid is very, very small. So I don't have a number in front of me, for example, but like you might calculate like, okay, if I'm going to sell a SPY put, I might have to put up X dollars and I'm going to make X premium, and my rate of return annualized is only going to be, let's say, 50%. Now you might say, oh my gosh, that sounds great, 50%. Me, I don't usually make trades that is 50%, because I want to like target like 200%. I want to like shoot for the moon, miss, and hit the stars. I don't know. That's kind of what I do. So those are kind of the things that I look at. Hopefully that answers your question. You know how it works. And then as you start kind of trading, me personally, I trade the same stocks all the time. I have like a core group that I trade a lot, and then sometimes I'll like add one or two, that kind of thing. And as you trade particular stocks, you kind of get the sense of sort of how they might behave, right? So, you know, how they fluctuate over time. And here's the thing. If you are trading a covered call, let's say if you're buying shares and then you're selling a covered call against it, don't buy something that you wouldn't want to own for a really long time. Warren Buffett, I think, says that. Don't trade stock that you wouldn't want to own for 100 years. So it's kind of like have that mentality that it's got to be a good quality company, right? So like I'll give you an example. Sometimes from time to time, I'll trade GameStop. I think it's kind of like a crappy company. I mean, I shouldn't say that. I don't mean that in a derogatory way. I mean that it's not like some strong like Apple or Tesla or something like that, right? But sometimes I'll trade it because it's got a lot of volatility and I just do it kind of short term, maybe like boost my return a little bit. However, if you're trading something, you want to really be in tune with, okay, I might own this for a long period of time. So you have to be okay with that. And that's kind of the same case when you sell a put, the same thing. If you sell a put on some crappy ABC stock, you know, just because you think it's a great deal, and then it goes down and you have to buy the stock, I mean, you know, you want to think about that at a time. So you really only want to sell puts on stock that you really are okay with buying at that particular price, right? So hopefully that helps. Happy trading.